The moment we have been waiting for years in the stock market just transpired. New all-time highs for the stock market. Dow, first time ever, closing over 37,000. Four main points I want to address in this video that we need to go over in this beast of a video here today. And man, is this a beast, okay? First thing is, markets at all-time highs. What happens from here? We need to discuss this. The Fed's making some big changes here. What is going to transpire now? Okay, we've got to speak about what stocks are going to outperform in this sort of market, what stocks are going to underperform in this sort of market. We're going to talk about some shock. There was really like two shocking things that Jay Powell said. One specific that I think a lot of people glossed over. And the moment I heard him say this, I said, "Oh my gosh! Like I can't believe he just said that." And there was an individual who also caught this as well, Jeffrey Gunlock, and I was like, thank goodness somebody else caught this because this was massive. We're going to talk about that, and that changes everything, to be quite honest, okay? And then the last thing we'll speak about in today's video is, am I going to change strategy? The Fed's clearly changing some stance on some things that we'll get into, and so am I going to change strategy in terms of how I'm buying? Am I going to hedge more? Am I going to hedge less? Am I going to buy stocks more aggressively? We'll speak about all that in this video as well. So appreciate y'all joining me as always. Thank you for joining me for this beast in this historic video here today, folks. Yeah, historic. Dow closing over 37,000 for the first time. We've been waiting for years for this, and it finally happened, okay? Alrighty, guys. So let's go ahead and start jumping through this. A lot to go through in this beast here today, okay? First place I want to start is look at the unbelievable outperformance by the Russell 2000. The Russell 2000 today was up 3.5%. That's versus 1.4% for the Dow, 1.38% for the NASDAQ, and 1.37% for the S&P 500. In this sort of market, you've got to expect the Russell and small cap stocks to outperform. I was talking about this several months ago. If we go into this sort of market that I think we're going into, the small caps will outperform significantly in that sort of market, and that's exactly what we're starting to see play out here. If you want it even spelled out a little simpler than this, right? The Russell has outperformed for years. It has been an underperformer for years, right? And that's due to the interest rate environment, the high inflation, everything like that. And you look at the Russell, we're still significantly away from where it actually reached all-time highs way back in 2021. We're significantly still away from that, right? Crazy to think the NASDAQ's still actually not at all-time highs right now, despite how strong tech stocks have been, right? And the Dow Jones Industrial Average, right, being at 37,000 plus, you've got to understand this is insanely important that the Dow just hit a new all-time high. The reason this is so significant is this is the index that the masses pay attention to. The people that are really into the stock market, people like me, maybe a lot of you guys out there that watch my channel all the time, and you're really in the stock market. The Dow for us is kind of like a whatever index. We pay a lot more attention to the S&P 500 and to the NASDAQ, to the Qs, right? But I'm telling you, for the masses, it's all about the Dow. This is the one that makes headlines in mainstream media that gets fed out there to everybody. So when people hear that, oh, the Dow just made a new all-time high, the stock market's reaching all-time highs, it's a change of perspective. It gets a lot more people interested in the stock market that maybe hadn't previously been interested. Wait, the stock market just hit an all-time high? Maybe I should look into that. We know it's human nature that if people hear other people making money, they want to go ahead and check this thing out. What's going on over here? How are all these people making all this money? New all-time highs? Ooh, this sounds intriguing, right? And let's be honest, none of the other indexes are at all-time highs right now, right? At least in terms of the NASDAQ and the Russell. So this one's at all-time highs. Even the S&P's not technically at an all-time high right now, right? Even BTC still significantly away from all-time high in terms of Bitcoin. It's not even remotely close. So the only thing you really have that's out there as an asset right now is the one thing that garners the masses' attention, right? Which is the Dow Jones Industrial Average. So this is very important. Now, I want to pull up this for you guys. This is a 1 month chart of the Russell versus other indexes. In the past 1 month, the Russell's up 15 percentage points. The Dow's up 8 percentage points. And Qs are up about 7.5 percentage points, and the S&P 500 is up just over 7%, right? So the Russell's already starting this thing I was talking to you guys about a couple months ago of this massive epic outperformance, right? It's already starting that. This could just be the start, something to keep in mind here, okay? Now, in regards to the small cap stocks, like if I look at my best performing stocks today, it was those high growth, small cap type stocks, right? ELF is technically now a mid cap stock, but it still kind of gets grouped in a little bit with the small caps. And look at the move for ELF today, $10,000 plus move up 8%. It was my best stock overall today, right? My best stock by far. And you look at an ELF, look at the 1 month on ELF. 49%. If small caps continue to run and this rotation continues to go, ELF will be 200 before you know it. It'll be 200 before you know it. In this sort of market with what we got going on here now at this point in time, these stocks are starting to run, and they're starting to run fast, right? And I thought it would draw your guys' attention to this, because this is something that came out last month, right? Remember this performance. In the last month, is up nearly 50%, right? And, a lot of people get scared about, they hear about an insider selling and things like that. You got to understand, insiders are almost always selling stocks. Like, this is very common. Like, they usually place these orders to, for certain shares to be sold way in the future, right? I could have looked at this and been like, oh my gosh, I got to sell my ELF stock, and just missed out on that ridiculous amount of gains, right? Also, short seller reports and those sorts of things. Like, I'll look at it, but I never make my investment decisions really based upon, this guy's shorting it or that guy's shorting it, right? This person shorted this Spruce Point, right? They said the stock was going to go down 45 to 65%. It's going to go down huge as recent sales momentum evaporates. And I'm just like, okay, you guys can believe whatever you want. This is ELF's growth over the last several years. You could keep betting against the stock and keep betting against the stock and, this is a top, this is a top, this is a top, this is a top, this is a top. I mean, come on, man, that's a silly game to play. That's a silly, silly game to play. I want nothing to do with that game, okay? So the moral of that story is, do not make your buy and sell decisions on a stock based upon if management is buying or selling the shares, especially if they're selling, because usually they are net sellers. They're always getting these options, grants, and all types of things, okay? And secondly, short reports. You can look at them, but also don't make your investment decisions based upon, somebody shorted my stock. Because guess what? Some other, maybe even more influential investor might have went long the stock as well, okay? Something to kind of keep in mind there, right? FOMO, another stock performing tremendous now. This stock is up 5% plus. It's significantly outperformed the other indexes, significantly outperforming, obviously, even the Russell 2000, right? And I look at a stock like FOMO. I mean, it's kind of the perfect scenario. Their losses are starting to be cut down. Obviously, you have interest rate worries starting to go away, and that's just something that benefits a company that's a high-growth company like a FOMO in a massive, massive way. And look at the stock in the past month. It's up 32%, right? That's versus the Russell was up, 15%? That's versus the Dow was up, 7%? NASDAQ and S&P 500 were up 7%, right? These are sorts of stocks that if we're actually going into this real market of rotation, these are stocks that perform tremendously good and just absolutely shine. And the crazy thing is a stock like FOMO could 3x or 4x in the next 12 months. And that wouldn't even be that crazy. For this stock to go to $9 or $12 would not be that crazy. All that would mean is just they cut down their losses dramatically more, and the interest rate environment's getting a lot more, let's just call it in a lot better place, while they're still attracting a ton of subscribers and revenue year after year. Like, that's nothing for a stock like that, right? You look at a stock like Honest, 86% in the past month, right? Carly got the ship pointing in the right direction. You add on that with a better interest rate environment and rotation, and all of a sudden these stocks are blasting higher. It doesn't take a lot of money in these stocks. A little money to rotate to these sorts of stocks, folks, is epic in terms of the gains. On the downside, when people are just selling these stocks, it was brutal, right? Look at what these stocks performed in 2022. It was obliteration, because it's just selling pressure on selling pressure on selling pressure on selling pressure, right? And now we're just starting to go into the complete opposite of that situation, right? Even look at a stock like PayPal. Even this baby's starting to perform. And Alex Chris hasn't even really proved all this stuff yet. Wait till he starts proving stuff in 2024. That's going to be really fun. And this stock's already significantly outperformed the S&P 500, the NASDAQ, and the Dow. Already 13.3% just in the past 1 month, right? This is another one of those stocks, fintech related. I mean, look at a stock like Affirm. Affirm's up over 300% this year, folks. 300%. It happens quick. Even stocks like Foot Locker, right? Foot Locker's made a 40% upward move in the past 1 month. 40 percentage points. This is what you see playing out, okay? Now, let me ask you this question, trivia question for you. What was the best stock in the entire Dow 30 today? The best stock in the Dow 30 today. Do you know what it is? Give you a second here, okay? I'll show you what it is. It was WBA, the beaten down dog stock that is WBA, Walgreens Boots Alliance, was the best stock in the Dow 30, and not just by a little bit, but by a significant margin here today, over a 7% upward move for a stock like that, right? Listen, Walgreens, look at the dividends this company's paid out over the last several years, right? Just think about this logically. They pay out crazy dividend money, right? They're a cash flow machine. That's not going to go away. They're going to remain a cash flow machine. And all of a sudden, people are going to start potentially getting less on treasuries. Oh, guess what they start looking for? Yield. And guess what's one of the best yielders out there? A company like a WBA. And then look at that stock's performance here recently as yields have started to go down. And look at Walgreens and look at it on a day like today, right? 7% plus upward move. This is rotation. Stocks that are not doing well in this sort of market are stocks like Meta, right? Meta had its tremendous run. Now it's chilling out. We got money rotating. It's clear as day money's rotating out of these big tech stocks and into the smaller stocks. It's clear as day because you're getting all this upward momentum in the market and you're not getting the upward momentum in these big tech stocks, right? Meta was up 0.16% today on this record-breaking day, this new record day, and Meta was up 0.16%. Well, guess what? Meta carried us. Meta carried us for much of this year, right? A stock like Tesla carried us for the first half of this year, right? While a lot of other stocks, those FOMOs and those Honest and all those stocks were still not performing well in the first half of the year for the most part. Stocks like Tesla carried us, right? Look at Tesla today, 0.96%. 0.96%, it didn't even do as well as the Dow or the NASDAQ or the S&P 500, right? Look at a stock like Amazon today, 0.92%. Amazon couldn't even keep up with the indexes today. That's clear as day rotation, selling pressure from these stocks to rotate in these other places where there's opportunities, right? And not to say there's not opportunities in Amazon's, Tesla's, and Metas. There is. It's just for the moment we're in right now in this market, people understand you're getting 4%, 5%, 10% gains in other stocks. You got to move your money there. And that's where a lot of these traders and these, folks that focus a little more on the short term, that's exactly what they're doing in this market. Me as a long-term investor, do I say, oh my gosh, I got to sell my Amazon, I got to sell my Meta and move my money over here? No. Okay, I'm not playing that game. That's a game of, moving money around. Heck no. That is not that's not what made me successful, okay? My name of the game is staying invested, great companies, long-term. Let the short-term stuff be what the short-term stuff is. If they want to sell them off a lot more, I'll gladly pick up more shares of these companies, right? They're great companies for the long term, right? Look at big tech in general today. A lot of weakness in big tech, right? On a great day for the market once again. Oobity Booba stock was down. Adobe was down. By the way, it's down big after hours, down over 6% after hours. IBM was down today. Mr. Softy, Microsoft was down today. Are you kidding me? On this type of day? With Jerome Powell saying what he said and it's down? And then Google McDougal barely eked a gain, right? Rotation, rotation, rotation. I told you guys it's going to happen, and sure enough, it's playing out now, okay? Now, next up here, Jerome Powell shocked me by what he said right here. Jerome Powell was asked very blank point, are you guys going to wait until you hit 2% inflation numbers to start lowering rates? And Jerome Powell's response to that shocked me. I could not believe what he said, okay? I could not believe it. He said you'd want to be reducing before inflation reaches 2%. So he just opened up the door, which is not something he's really done because in the past he's really led on, like, we're going to wait till we get to 2% and 2% and then we can, worry about lowering rates. Now he just opened up a can of worms and opened up the door to the Fed lowering rates before they're at 2%. Because remember, the CPI is still, we've made a ton of progress, but we are still significantly away from 2%. And if you look at core inflation, substantially still away from 2%. We've made great progress on inflation. Everything's going our way. But now he's talking about he wants to potentially lower rates and reduce before you hit 2%. That was huge. That's a monumental change in really the tone. And I had not heard him say that specific before. Before he's really let on about, we're going to hit 2% and then we'll worry about that. Now it's like, they could hit 2.5 in the CPI and maybe they'll start lowering rates. Like, wow, what a change. That changes everything, to be quite honest, in regards to this, right? They also asked him several other questions, right? He said the Fed is just at the beginning of discussing policy easing. I thought that was a big statement, that the Fed's already at the stage of talking about easing of financial conditions and discussing like lowering rates and those sorts of things. The fact that he wanted to go there already, I was not expecting him to go there already. I thought, okay, he might go there in the springtime, maybe the summertime. Spring or summer, he might start talking about, we're starting to talk about, if we might want to look at lowering rates or something like that. I figured they would be a little bit longer out before he would let that cat out of the bag. And we're already talking about, I was like, whoa, okay. He says, we're aware of the risk that will hang on too long to a restrictive stance, and we're very focused on not making that mistake, which is, once again, a kind of a very dovish tone by Jerome Powell here. Very dovish tone. We're looking hard at what's happening with demand. That's a very dovish Jerome Powell here, okay? Federal Reserve sees 3 rate cuts in 2024, the dot plot shows. So the dot plot basically is all the individuals that are, all the important individuals at the Fed, kind of taking their commentary on kind of what they're expecting overall. This does not mean this is for sure going to happen, but it means like if you were to take the consensus and kind of what everybody's expecting, ultimately, the Federal Reserve sees 3 rate cuts in 2024, right? And that's crazy because that's even if we don't hit 2% they're talking about now at this point in time, which once again changes the environment completely here. And this starts to get into politics. Do people feel like certain, the Fed's also going to maybe potentially change their stance on this whole 2% thing, and now they're not committed to 2%? That's interesting, right? And people are starting to feel like maybe this is political motivated. And I don't know. We'll see, okay? No, I also thought this was big, because they specifically asked him, are you guys looking at, kind of wrapping up quantitative tightening? And what he said, we're not talking about altering the pace of basically the balance sheet runoff. And he's basically said, no, that's not something we're considering. So I thought that was at least some hawkishness in the press conferences. At least they're not talking about ending quantitative tightening right now, okay? So here we have a very interesting situation, where if we go back a year ago, obviously Jerome Powell was super hawk, right? And I felt like very recently he kind of moved a little bit more toward the middle, but maybe a little bit still maybe on the hawkish side. And now, I'm just going to be honest with you guys, he's really moved significantly out of the middle, and really, based upon that Q&A portion specifically, which I think you get the most truth in the Q&A part, to be honest, because you can only prepare so much for those questions. I thought he moved very dovish. And so now the market looks at this and they say, wow, we're really going to get more of a dovish Fed moving forward in 2024 versus a hawkish Fed like we've had for the past 2 years. Because to be very clear, 2022 and 2023, we had a very hawkish Fed. And now we're talking about a dovish Fed in 2024, which is a huge change there, right? Now, this leads into FOMO, right? Fear of missing out. We know a lot of people are very underweight equity still, or still have been in the camp of recession, of the Fed's going higher, Fed's not lowering anytime soon, all those sorts of things, right? And so they have chose to not invest in the markets, or let's just call it invest a very small amount compared to what they could invest in the market. So we could breed a period of FOMO, and we've had several periods of FOMO in the past, right? We've had just a couple in the past 5 years, really, right? I think we're entering a stage of FOMO right now, actually, in the market, which is, people did not really buy the dip like they should have in 2022. They've watched the stock market rocket up higher, and they're, now all of a sudden the Fed's starting to go a little more dovish, and they're really starting to be like, crap, man, did we screw up here? Did we miss this opportunity? And I think you're starting to breed some FOMO in this market. The other time period in the past 5 years we had a lot of FOMO was certainly at the end of 2020 going into 2021, right? We had that massive epic crash in the market. Obviously, everybody was very concerned about what the future was going to be, and Ronan, all those sorts of things. A lot of people chose to not really buy stocks and get very excited about the markets. And then we had a big bull run, right? Really started in the springtime of 2020 and ran all the way through the summer and into the fall. And you had a lot of people that said, oh my gosh, man, like I need to get in this market. Things are looking better. Company earnings are trending up. I need to get positioned. And then we had a big FOMO bull run, obviously, in 2021 overall, right? And so that was definitely a time period you had some FOMO in the market. You had another FOMO time period for people that weren't really buying the dip in late 2018. I was certainly buying the dip, and it was painful. It was a painful market to go through. But then coming out of that, you had a very rapid V-shaped recovery. And as that recovery got stronger and stronger, more and more people said, oh crap, man, like we might have screwed up here. And FOMO started to come into the market. In 2019 ended up being a booming year all the way into basically up until about January of 2020. And then obviously the Rona crash happened after that. That was a huge FOMO cycle. And then you definitely saw one of these cycles coming out of the great financial crisis where you had this huge move up from the 600 level on the S&P 500 all the way to 1,000 plus. Not everybody was positioned for that. Caught a lot of people off guard, like, wow, the market was going to come back that strong a V-shaped recovery. Caught everybody off guard. And then you kind of had this FOMO period after that of another bunch of people saying, crap, we got to get positioned in this market, right? So we could be looking at a time period now at this point in time where a lot of FOMO could start breeding into this market where people are saying, crap, man, did I miss this? Are we looking a lot better? And remember, consumer confidence, small business confidence could definitely start to improve significantly. I've been talking about this. This hasn't been talked about enough, other than myself. And if that happens, whoo, man, are people going to start freaking out and being, whoa, I am totally off sides. Now, this leads to Wall Street. Big, big, big money. Because we got an awkward situation happening now on Wall Street, folks. Look at this. Look at this, okay? I posted this the other night in Breadcrumbs tab, right? In the private stock group's Discord chat. I said, another year where most prestigious Wall Street firms are going in bearish. And this is exactly where they're going in. Here's the thing, folks. We're above all their price targets right now in the S&P 500. We got a whole year before their year-end 2024 price targets, folks. What do you do if you're Goldman Sachs now and you're seeing that the S&P 500 is already higher than where you're at and the Fed's expected to go dovish and earnings are expected to strengthen considerably next year? What do? You're Wells Fargo and you're now expecting the market to go down next year? That's not a comfortable feeling to feel when you're expecting a dovish Fed that's dot plots showing, 3 rate cuts. Woo! What do you do if you're Barclays and Morgan Stanley? You're expecting significant downside next year? What do you do if you're JP Morgan? Oh boy, okay. And so this is an awkward stage where these Wall Streeters are going to have to figure out, do we stay bearish and potentially this market goes big risk on in 2024 and then we're caught off sides and we look like complete, crazies in terms of our bearish stance? This is a big, awkward question we got for the market here moving forward, folks. A big, awkward question. And I'm just waiting on it. I'm waiting to see what Goldman Sachs is going to do and Wells Fargo is going to do and Barclays and Morgan Stanley and JP Morgan. Are they going to stick with their predictions here? Or are they going to say, you know what, let's throw in the towel on this whole thing and let's get ready to roll because earnings are going to strengthen next year and we got a Fed that's now going dovish? Woo-wee! That's a hard thing to kind of work against there, right? Now, with that being said, I'm personally still expecting volatility in the first quarter of 2024. No doubt about it. I'm absolutely still expecting at some point in that first quarter a big volatility spell. I don't know what's going to come of that. I don't know what's going to happen there, but I can tell you there's going to be some folks that want to take some profits in that first quarter at some point in time, being that we've had a big bull run, and I think a lot of people are kind of waiting until after this year because they don't want to pay taxes, obviously, coming up here in a few months. So I think they're kind of waiting to play that game. But yeah, I'm still expecting at some point in time we're going to have some sort of big downward move in Q1, and I gladly welcome it. If we don't, I would be very surprised. If we don't have some sort of 1, 2, 3 week span at some point where the market goes down significantly, I'd be extremely surprised. Let's just put it that way. All of a sudden, this fear, that fear. Right now, we're kind of like, there's just this bullish sentiment is kind of brewing, and it's brewing higher. And that could happen, continue on for the next few weeks into the end of the year. But, at some point in time, something's going to happen there and volatility will spike up there. Okay. No, the interesting thing is the bond market is tanking. I mean, treasuries are just going down and down and down. Everything from the 1 year to the 10-year is tanking. And this is obviously boding very well for stocks. And part of the reason we're getting such strong performance in many stocks right now is the fact that treasuries are just going down and down and down and down. And we don't know, where the bottom is in terms of these treasuries, but it just doesn't seem like it's right now, right? And so this leads into a very interesting trillion-dollar question. A very interesting trillion-dollar question, and it is this, okay? Money market funds have obviously gone to all-time record highs here recently. We're well over $6 trillion in money market funds. Well, folks, okay, over $1 trillion of that came, whoa, my baby woke up. Hold your horses, just a flip and flapjacking moment. Alrighty, folks, my baby's eating in the background. You might not be able to see him. Oh, yeah, he's right there, okay? So I'm on baby duty right now. So, if he makes any noise, I do apologize, but I got to do what I got to do, okay? So this is a $1 trillion question, right? Because now treasuries are starting to shoot down. So you're not going to make as much on money market funds, let's just call it in 2024 as potentially 2023. And so what happens here, right? Does this money return over in the stock market? And if it does return over in the stock market, where does it go, right? I think that's another fair question. Does it go to big tech? Does it go into some of the smalls and mids that are showing a lot of strength out there, right? Because obviously you're not going to get all this money to go over the stock market. But is there $1 trillion out there that could potentially go? I wouldn't be surprised at all if in 2024 you start to see this number decline and decline. It's likely going to peak here in Q4 when the Q4 numbers come out, and then I wouldn't be surprised at all if you start seeing a decline in that in 2024 as the year kind of ticks on there, and eventually maybe 18 months from now we're at maybe $5 trillion in money market funds. That would just be kind of my thought process here, right? Now, if we're talking about the Fed cutting, this has ramifications that go way wider, way bigger and way wider than just, oh, this could affect this could affect that. When it comes to stock market, what about this thing? This thing, it's called margin. So no one's wanted a piece of margin recently, as in the last couple of years, because the Fed kept raising rates, which means if you were to take out margin loan and invest on margin to buy stocks, you're paying through the roof. I mean, even people that have a lot of money, if you want to take out margin right now, you're at like 8% rate, right? Well, if all of a sudden we're talking about a situation where the Fed's going to lower rates, then people are going to want to take out more margin, right? If you got a more dovish Fed, they're going to want to likely go more margined out, right? If you look at margin debt as a percent of the S&P 500, this was as of the end of October. This is Yardeni numbers here. We're all the way back to 2003, 2004 levels, which is pretty shocking. The highest we ever got was kind of coming out of the great financial crisis right around there. And that's because at that particular time period, interest rates were on the floor. And so we actually remained at, almost 3% of the S&P 500 was margin, in terms of market cap, was about 3% was margin debt. And that's because, you had interest rates on the floor and you didn't have that much scariness coming out of the great financial crisis. After you got through that, it was kind of like the employment picture just got better and better. You didn't have too much geopolitical concerns. It was okay, right? And so that's why it remained at a very high number. Now we're at an insanely low number. And when it comes to margin debt, the latest numbers we have was the end of October, $635 billion on margin, right? Now, that compares to $935 billion of margin in the same time back in 2021. So in a matter of 2 years, over $300 billion of margin debt got extinguished, essentially, right? Which makes sense. If you have to all of a sudden, back here, people were paying 3-4% to take out margin. Here, people are paying 8 to 10%. Well, 8 to 10% is usually what you can expect to make in the S&P 500 in a given year, right? People will gladly take margin many times when it's 3-4%. By the way, it's not a smart idea to take it no matter what. I'll just be honest with you guys. Stocks are so volatile. And, also people get tied into margin calls and all those sorts of things. So I would never take out margin, right? To back this up, the first time we ever hit over $600 billion in margin debt was back September 2017. So you think about this for a moment, and we're all the way back to 2017 levels on margin debt, right? I'm telling you, if the Fed lowers rates, you're going to see, unfortunately, once again, I don't believe in it, but the bottom line is, folks, you will see margin debt go up and up and up over the next year or two if we're talking about a Fed that actually is going to continue to lower rates in a more dovish Fed. It's what's going to happen, right? And so I think that's going to be really, really dang intriguing, right? Now, from the retail investor, sentiment, and then we'll get into my strategies. Am I going to change my strategies? How am I looking at all this with the Fed kind of changing their tone and stance here? Sentiment with the retail investor crowd, I will say, and I really felt it today specifically, I feel like this is the most bullish and excited, I guess you say, not bullish, this is the most excited I've seen retail investors in years. The last time I really noticed retail investors this excited was probably 2020. Are we at those levels of the end of 2020, beginning of 2021? Absolutely not. Will we ever reach those levels again? I'm not so convinced we'll ever reach that level of retail excitement and everybody's going to be a billionaire in the stock market. If we do, it could be 10, 20 years from now. Those rare occurrences when it's over the moon, just insanity, right? And it all ended with NFTs, by the way, in terms of that bull cycle. That was the last pillar to take us down. I don't think we'll see that for probably, a decade or maybe 2 decades. That is extremely rare to see that level of that many people interested in, some sort of asset classes and everybody's going to get rich and all these things. But I will say the retail investor, I think, is the most excited they've been in certainly years, right? And so that's just a little food for thought in regards to that, okay? The sentiment has improved. Now, strategy. Will it be changing strategy? Okay, so let's talk in depth about this and let me kind of share my opinions and perspectives, okay? So first off, the Patreon portfolio, right? The Patreon portfolio is an account I buy with every single week. And, I do have a hedge on in that portfolio. I buy every single week. So will I be changing strategy with the Patreon portfolio? The answer to that is absolutely not. I'll still continue to buy every single week, every single Friday, just as I do, right? And by the way, if you want to join me on Patreon, check out the pinned comment down there. I'm actually making moves in there on Friday. You get to see all the moves I'm making in there, plus be part of that particular Discord chat there, okay? What about in the big dog portfolio, the public account, which is available in my private stock group? Everybody's gotten to see every move I've made in this account for the past 6+ years. Building this account from nothing, now $1.8 million plus, right? Am I going to change strategy here? And the answer to that is no. No. I buy every single Friday in this account. I am not changing strategy here in regards to the public account either for the private stock group. No. What about private portfolios? Am I going to change strategy there? The answer is no. Absolutely not. I am not changing my strategy with private portfolios either. What about hedges, which I basically just call insurance, right? It's basically insurance for my portfolio. Am I going to change strategy there now that the Fed's going more dovish, the market's going more bullish, sentiment's going more bullish? Do I feel like I don't need hedges on anymore? And my thought process on that is I need hedges. I need insurance, absolutely, right? Just because you feel good doesn't mean you don't need health insurance. Just because you're likely not going to get in a car accident doesn't mean you don't need car insurance. That's the bottom line with that. And that's the way I think about it, right? So I need to continue to have hedges on for 2024. I need to have them on for 25. I need to have them on for 2026 and 2027, every year kind of moving forward. Just with me, with how built out the accounts are now at this point in time, I need to have that. And also, I know there's a lot of excitement brewing out there, and there should be, but at the same time, we got to be honest, guys. We haven't really truly defeated inflation yet. We're starting to win the battle, but we haven't defeated it fully yet. That's the bottom line in regards to this, folks. All the numbers are still too high. We still got to get them down to where we need to get them down to. I'm also seeing little concerning stuff like this, okay? This is a house in the neighborhood where I have this. This is a neighborhood I used to live in, okay, years ago. And that house I rented out nowadays, okay? And I saw there was a house that went for sale on November 23rd. And the house listed for $1.395, and it's already contingent like a week and a half later at $1.395. And so that concerns me a little bit. Because I look at some of this and I'm like, dang, rates just barely dropped a little bit, and you're already getting like, and that's a big number for that neighborhood too, by the way. 1.4 is a pretty big number. Anything over 1.2 in that neighborhood's pretty high. So the fact that this baby could go at 1.4, I looked at that and I was like, we haven't even really seen mortgage rates come down that much. Like they went from like 8% to 7%. What happens if mortgage rates go to 6%, 5%? Could we see another brew up in real estate prices, a blow off top scenario over the next 1 to 2 years? And that's something I'm concerned with. And I told you guys a million times, this time period we're going through right now over the past few years reminded me a lot of the tech bubble, to come down from the tech bubble, right? And what happened after the tech bubble bottom? Then we had a real estate boom over those next few years, right? And then we had a real estate bust cycle. And I'm just looking out there and I'm like, it is something that's very concerning to me. And I mean, imagine a scenario where mortgage rates go down to 5-6%. And next thing you know, everybody and their grandma that hasn't been moving the last few years is all of a sudden moving. And prices are shooting higher. That's something that scares me. And guess what? That means inflation down the road, which means the Fed has to come back in and raise rates again at some point in time, right? Whether that be 25 or 26. That's a little concerning. So that's just something a little further out. And I'm just kind of seeing this. I'm like, oh boy, okay. And so the way I stay in the market is I stay balanced. I call it the balanced beam approach, because what I found time and time again is folks get too bullish or bearish in this market. And at the end of the day, folks, you don't want to get too bullish and bearish in the market. The people that usually make the biggest mistakes are the ones that get too bullish on the market, too bearish on the market. And I've just found over the past 15 years, I need to stay balanced. Like walking on a balanced beam. Can't go too far this way, can't go too far that way. I'm going to stay focused, stay on my strategies. Everybody else can get into the hysteria of, over the moon bullish, over the moon bearish, right? Last year at this time, everybody and their grandma, oh my gosh, people are like saying I'm an idiot for buying meta stock at $88. I'm like, what are we talking about here? Like, people are just crazy, okay? Now people are starting to get very hysterical about the Fed's turning dovish. It's so exciting and all these sorts of things. And so I just stay balanced in this game. I'm focused on building my portfolio my way, and it does great. And like, it works perfect for me. And that is what it is. That's just what I found over time, folks. Okay, stay balanced in this game overall. Okay, if you're looking to take your investing to the next level, you want access to all my different courses, access to the 6 and 7 figure Discord chat, everything like that. Then apply to join my private stock group. That will be the second pinned comment down there. The first pinned comment down there will be if you want to join my Patreon. See the moves I'm making in there. Okay, much love and have a great day.